Have you ever wondered why some investors are more successful than others? One factor that sets successful investors apart is their ability to focus on long-term goals instead of short-term gains. In this video, we will explore Warren Buffett's views on short-term thinking in investing and why it's important to adopt a long-term mindset instead. To start, we will discuss the concept of short-term thinking and its pitfalls. Many investors make the mistake of focusing solely on immediate gains, rather than considering the long-term potential of their investments. This can lead to overreacting to short-term market fluctuations, missing out on long-term opportunities, and ultimately failing to achieve sustained growth. Next, we will explore why Warren Buffett is against short-term thinking. As a successful investor and CEO of Berkshire Hathaway, Buffett emphasizes the importance of taking a long-term approach to investing. He believes that short-term thinking leads to impulsive decisions and missed opportunities, and that investments with long-term potential are more likely to produce consistent returns. Finally, we will offer some tips for how to adopt a long-term investing mindset by focusing on your long-term goals, avoiding reacting to short-term market fluctuations, researching and investing in companies with long-term potential growth, diversifying your portfolio, and staying disciplined and patient. You can potentially achieve more consistent returns and build a stronger portfolio over time. In conclusion, by understanding the pitfalls of short-term thinking, adopting a long-term mindset, and following these tips, you could become a more successful investor and achieve your long-term financial goals. Short-term thinking is a common trap that many investors fall into. It is defined as investing with a focus on immediate gains rather than considering the long-term objectives of your investments. While it may seem tempting to focus solely on short-term goals, this approach can have several pitfalls that can hinder your investment success. One of the primary pitfalls of short-term thinking is overreacting to short-term market fluctuations. When investors focus solely on immediate gains, they may be more likely to react impulsively to sudden changes in the market. This can lead to buying or selling assets at the wrong time, resulting in lower returns or even losses. Another pitfall of short-term thinking is that it can cause investors to prioritize short-term gains over long-term growth potential. While short-term gains may provide an immediate boost to your portfolio, this may not necessarily lead to sustained growth over time. By prioritizing short-term gains, investors may miss out on investment opportunities with long-term potential. Finally, short-term thinking can cause investors to miss out on opportunities to diversify their portfolios. By focusing solely on immediate gains, investors may neglect to consider alternative investment options or assets that may have long-term potential. This can limit their ability to build a diverse and resilient portfolio that can withstand market fluctuations and provide consistent returns over time. In summary, short-term thinking has several pitfalls that can hinder investment success. By avoiding the temptation to focus solely on immediate gains and instead taking a long-term approach to investing, investors can potentially achieve more consistent returns and build a stronger portfolio over time. Warren Buffett is a successful investor and CEO of Berkshire Hathaway, a company known for its long-term investment strategies. Buffett's views on short-term thinking are clear. He believes that taking a long-term approach to investing is key to achieving sustained growth and success. Buffett argues that short-term thinking leads to impulsive decisions and missed opportunities. When investors focus solely on immediate gains, they may overlook investments with long-term potential or make rash decisions based on short-term market fluctuations. This can lead to missed opportunities for growth and lower returns in the long run. In contrast, Buffett believes that long-term investments are more likely to produce consistent returns. By investing in companies with strong long-term growth potential, investors can potentially achieve a steady, sustained growth rate over time. This requires patience and discipline, as well as a willingness to overlook short-term market fluctuations and focus on the big picture. Overall, Buffett's views on short-term thinking emphasize the importance of taking a long-term approach to investing. By avoiding impulsive decisions, focusing on long-term growth potential, and remaining disciplined and patient, investors can potentially achieve more consistent returns and build a stronger portfolio over time. Adopting a long-term investment mindset is crucial for achieving sustained growth and success. Here are some tips on how to do so. First, it's important to make sure you focus on your long-term goals. What are you trying to achieve with your investments? By setting clear long-term goals and focusing on them, you can avoid getting distracted by short-term market fluctuations and remain disciplined in your investment approach. Second, it's important to avoid reacting to short-term market fluctuations. While it may be tempting to make impulsive decisions based on short-term trends, doing so can lead to lower returns and missed opportunities for growth. Instead, focus on the big picture and remain patient and disciplined in your investment approach. Third, research and invest in companies with long-term growth potential, looking for companies with strong fundamentals, solid management teams, and a track record of sustained growth. By investing in such companies, you can potentially achieve steady and sustained growth over time. Fourth, diversify your portfolio. Investing in a variety of assets and industries can help you mitigate risk and potentially achieve more consistent returns over time. This requires discipline and patience, as well as a willingness to take a long-term approach to investing. Finally, stay disciplined and patient. Adopting a long-term investment mindset requires discipline and patience. It's important to stick to your investment strategy, avoid impulsive decisions, and remain focused on your long-term goals. By doing so, you can potentially achieve sustained growth and success over time. Overall, adopting a long-term investment mindset is key to achieving sustained growth and success. By focusing on your long-term goals, avoiding impulsive decisions, researching and investing in companies with long-term growth potential, diversifying your portfolio, and staying disciplined and patient, you can potentially achieve more consistent returns and build a stronger portfolio over time.